Hello and welcome to The Rate Stuff. I'm Jack Izzard.
And I'm Peter Stimson.
On today's show, the inflationary winds of war are blowing. And the big question, Peter, is how hard are they going to hit the mortgage market?
Yes, unfortunately at the moment, Jack, things are not looking very good. I've seen a very large jump in swap rates following the Bank of England meeting.
Yeah, I saw Peter visibly blanch when those swap rates came out in the wake of that Bank of England decision. Things are not looking good, but stay with us. We'll unpack what they mean for you and what they mean for the mortgage market. Coming up on The Rate Stuff. So, we're talking about the winds of war. In mortgage terms, these are inflationary forces. I guess the question, Peter, is this an inflationary headwind or is this turning into an inflationary hurricane?
It's probably somewhere between the two at the moment. Which way it turns out is to be seen. I think the biggest problem at the moment is obviously the oil and gas prices. Oil is used for so much more than powering your car, as you're probably aware. Oil and gas is used in fertilizer, plastics, food production, so many other things. So, you know, instead of inflation heading down towards the 2% mark, which was predicted to do later this year, we're now looking potentially, if this carries on, inflation going sort of to 4% and potentially beyond. So, you know, having, as you said, the Bank of England almost kind of, you know, congratulating itself on a job well done.
A month ago, the Bank of England was basically polishing the silverware, patting itself on the back, saying, hooray, the war on inflation is won. And now that has completely been blown out of the water. All those sums have had to be rewritten. And the issue is inflation is back with a vengeance. And as you say, it's down to the oil and gas price. That's the mechanism that brings inflation through.
Exactly. Oil's up over 50%. Gas prices have doubled. And if you look at the swap graph going up now, you can see where we've gone since the beginning of 2025. Beginning of 2025, we got down to two-year swap was down to 3.35% at its lowest point. And the lowest point was actually March, beginning of March this year, just before the Iran war started. What's now happened, we've just hit 434. We've hit 434 off the back of the minutes from the Bank of England decision.
That was a huge jump today, Peter. I must admit, I don't think I'm going to embarrass Peter too much, but you visibly blanched when that number came out.
Yeah.
You were really shocked by how much the swaps had gone up.
Yeah, so we were around about 396 on the two-year swap as of last night. It went up this morning off the back of the oil price, sort of going up to around sort of $118 on Brent crude this morning. I think it wasn't a shock that the rates hold. I think it was a shock that everyone voted to hold. We've got obviously GDP basically at zero. We are probably going to go into some form of recession off the back of the fact that, you know, what's going on in the Iran war. We've got unemployment growing. We're now probably facing potentially a situation of stagflation where we've got inflation rising off the back of the oil price, the economy contracting, and, you know, rising interest rates. So the market is now looking at a situation where the Bank of England next move could well be up, and we could actually not face just one interest rate rise, but potentially two. So, you know,
it's not a great backdrop. So
that's not a great backdrop.
That's the economic backdrop. That's what's going in terms of monetary policy. For brokers who are watching, let's just talk about the front line. It's been a pretty grisly couple of weeks, hasn't it? We've seen lots of rates being pulled. The attractive rates have all gone. Nothing under 4% now.
No.
Lenders have repriced twice. You think there's probably another repricing?
There's another reprice coming almost immediately. So this is being filmed literally an hour or so after the Bank of England rate decision. Lenders will now be scrabbling around as we speak, repricing everything. You know, we've had 30 basis points plus chucked on in the last 24 hours. Everything will be getting repriced very rapidly. Not just a case of repricing, I would imagine at the moment, given the volatility and uncertainty, I would imagine some products will be temporarily disappearing out of the market. Some of the higher risk stuff may well start to disappear, at least short term. So potentially some of the 95, even some of the 90% higher risk products may well go short term because there will be a flight to quality, a flight to stuff that's more easy to price and doesn't risk that volatility around the edges. So, you know.
So lower LTVs, nice vanilla borrowers, they want no risk. That's the sort of thing we're going to see. What's the mood like amongst lenders. When we were preparing for this, you used the panic word, and I've never heard you say that before. Is it really that bad?
It will be challenging if you're sitting in a lender at the moment and you suddenly see that kind of movement. You're wanting to kind of reprice very quickly, simply because the fact that you're now looking at your margins and they're all underwater. So you will want to get new products and rates out there as soon as possible, simply because you're not countenancing the swap rate suddenly moving back that quickly, that fast. So as much as I know brokers kind of want sort of 24, 48 hours notice to get new products out there, these are exceptional circumstances. So I don't know what lenders will do in these circumstances. I mean, hopefully some of them can give reasonable notice. Hopefully they've got reasonably well hedged positions, but it's going to be challenging for some lenders, I would imagine, given the extraordinary circumstances we're seeing at the moment.
Okay, batten down the hatches. That's the position at the moment. Where next for the mortgage market, and where next for brokers and borrowers? Stay with us. Okay, so the picture right now isn't exactly rosy, but this isn't the first time we've been here. Everyone watching this will have memories of the chaos that followed the Liz Truss mini budget in August 2022. Peter, I've got that seared on my memory. It wasn't fun.
No.
How similar was that chaos to what we're seeing now?
It's not a parallel, I don't think. Rates then were shooting up, much faster, much quicker. Just in terms of how the rates were rising, the circumstances were obviously very different. That was unfunded tax cuts. This is a global situation driven by, like I say, rising oil and gas prices and the general impact on inflation. So I think they're quite different in that regard. And Liz Truss was very short-lived. So rates went up thereafter, driven by obviously the impact from the Ukraine war on energy prices, plus the global shortage.
She often gets painted as the kind of villain of the piece, doesn't she? But actually, she was only one part of that mess, wasn't she? She was only one factor out of many.
Yeah, she wasn't responsible for the rise in interest rates that we got. So there was a spike in gilt rates, which drove up swap rates based on the fact that it was unfunded. They then recovered when she lasted, was it, I think, the length of the letters?
42 days, I think, yes. So,
like that.
Pub trivia quiz, shortest ever serving UK Prime Minister, beaten by lettuce.
Beaten by lettuce, exactly. So, so if you look kind of what happened, there was a big spike in gilt rates. They kind of dropped off after, she backtracked. Then there was a rise in interest rates thereafter. That was driven by, obviously, like I say, the Ukraine war and the recovery from COVID and the supply chains kind of being, not in place to sort of cope with demand. Yeah. So it is different in that regard.
Yes. So at the moment we've got this obvious cause, which is the war in the Middle East, and that's driving up oil and gas prices, and we've got this kind of wave of inflation coming our way. So that begs the question of how bad could it get? And I guess it all boils down to how bad inflation gets, how long the war goes on for, right?
It does. I mean, it really comes down to how long and where does the oil and gas price end up for what length of time. So, oil, it was around $70 a barrel. If this gets resolved quickly in the next sort of week or two, and oil drops back, I would imagine the swap prices will drop back very quickly as well. So if you think about kind of where the UK economy is at, like I say, there's very little growth or virtually no growth. Unemployment is rising, and the damage that's been done in the last sort of month or 6 weeks or so, or where we'll be at the point this ends, will basically probably be the situation the bank needs to cut rates and maybe even cut them further than it did before.
Yes. So if you take away this inflationary crisis, actually there's quite a strong case for cutting interest rates, isn't there? Because there's no growth, weak employment. So if the war just blows over, we could actually see the Bank of England come out with a cut quite soon.
Within a reasonable period of time, exactly. So, you've had literally 100 basis points go on the swap rates in a matter of sort of some 3.5 weeks. You could get a similar level of drop within a similar time frame.
Right.
So
a complete reset, basically.
It could be a complete reset if like I say, this blows over very quickly and commodity prices drop back to similar levels.
Okay, that's option one.
That's the very optimistic.
I like option one.
Option one is the incredibly optimistic scenario. Okay. So, even if this does reset, it may not be that commodity prices come down that quickly or reset that quickly. It could be a gradual drop down. But, that's the very optimistic scenario.
Well, I like that one. Give me option two then, Peter.
Option two, there's various versions of option two, as you can probably imagine, is this drags on for a considerably longer period. And obviously the oil price stays higher, $100+ a barrel, lots of versions, whether it's 110, 120. God forbid it gets up around 150. Inflation gets embedded, pushes through to the supply chain. So, plastics, fertilizers, all the costs of transporting goods. So we end up with 4% plus. We get potentially a couple of bank base rate rises, and we get stagflation. So we get zero negative growth in the economy, and unemployment rises, but obviously there's inflation in the economy, so interest rates stay high, and we end up with some version of the early 70s oil crisis.
Oh right, that really is cheery.
Well, that's the really negative one.
Yes, what I guess the key difference there is you're talking about the inflation becoming embedded in the wider economy, so sort of contagion. It's no longer about just oil and gas prices being high. It's all those other things, those downstream effects.
Yeah, it's the fact that every fertilizer depends on gas. To make
transport
costs, packaging, all those other things that are kind of dependent on it, and it's a kind of a knock-on effect.
Yeah. Okay. So if that happens, we could be looking at several base rate rises potentially.
A couple potentially. I mean, it depends where we end up.
Yeah.
So there's lots of kind of versions of that depending what oil ends up, how long this lasts for.
Got it. Yeah. I don't like your parallel with the 1970s.
I mean, that's probably maybe a bit OTT, but it's inflation is pretty high at that point.
All right. So we've got that pretty broad range of options there. You're not really a betting man, but go on, take a punt.
I mean,
where are we going to fall from that range of options?
I mean, my view or thoughts or hopes, probably to put it like that, is it ends quite soon. He's known as the taco president for obvious reasons. There is no specific goal that defines victory.
Yes.
I would hope, or rather imagine, that victory is declared rather soon.
Yeah.
And
yes, that is one positive about the lack of any clearly defined aim, is that the president can just say, "Hooray, we won! Go USA!"
We've degraded them enough.
Yeah. And so that gives him an exit ramp. Okay, now that's good to hear. I guess a question that everyone who's watching this, who's a broker or an intermediary, is well, where do I fit into this? Because clearly you've talked about the panic, the concern amongst lenders, products being pulled left, right, and centre. Yep. Brokers are on the front line. They'll be having lots of customers who are due to remortgage or potentially first-time buyers saying, "What do I do?" What's your advice to people who are in that position right now?
So if you look at if you're a buyer, it takes on average something like 4.5 months for it to go through. That's kind of the weighted average time for from an application to go through to completion. So obviously the anticipation is obviously rates at the moment have risen by around about 100, will rise by around about 100 basis points. By the time this has all got pushed through, the swaps got pushed through into pricing, which is obviously a pretty significant rise. However, as much as they've gone up, you've got 4.5 months from applying for a rate going through to completion to actually change the product with your lender. Now, there's an extremely good chance that in that period of time, this gets resolved, pricing comes down, and the swap curve we've seen spike like that goes the other way. And at that point, you just ride the swap curve down the other way, take a new product out from your lender as it comes down, and you move on to a much lower rate as it comes down. Same with the remortgage. You can apply 3 months before. Okay, you're going to unfortunately be taking a product which is much more expensive than you hoped for, but again, you just ride the wave down as it comes down the other side, which it hopefully it will do.
Yes, and this is where brokers are really going to be earning their commission. They'll forge relationships with customers that hopefully they will keep for a long time, because these are challenging times. I think a lot of borrowers will be very unsettled by it. Brokers need to dig in and show their mettle. So if that's you, we wish you the very best of luck, and we'll be thinking of you because this is not going to be easy for anyone.
It's a challenging time. It's really just kind of thinking outside of the moment and kind of looking ahead and taking a view that this isn't going to last forever. It's hopefully a shortish term issue that's going to be resolved.
Okay, Peter, thank you very much. Well, a note of some positivity to end on there. It's been a bit grim today, but I'm afraid we have to say it as we see it. And these are not good times in the mortgage sector. But do join us for the next episode of The Rate Stuff when Peter and I will unpack what's happened and where we